VIX Market Volatility Index CBOE. And what is it? It is a fear indicator. What is it related to? It's related to the S&P 500. This is the S&P 500 right here. It's a monthly chart as well. And you can clearly see here within this monthly chart that when this big green monthly June and May was going up, and the bigger part of the selling had increased in the month of June. Now, when you go to stockmarketpunting.com homepage and you look under S&P 500 indexes there, it's in chronological order. Go back to 425 of April of 2011 and a correction around the corner. And it was going to be a big correction because stock markets were overbought and it was time to be taking profits, and people don't know how to do that. And then markets come down, the fear increases, people start selling. That's one of the reasons why we have the bigger breakout right there where this is because people don't know when to get out of the markets, and the fear always starts to increase and or break out when people start selling more down toward the bottoms. Just a factual event that happens the same way consistently. One of the things that we would like to point out to you, though, that you understand it's related to the S&P 500 stocks. And we had a great S&P 500 correction here. That's what this is related to now. MMTs for the new MMT students. We have not broke the 2011 highs, MMTs. Now, let's take a look over here in time when people get very pessimistic. Look at that 2008. Man, that was a peak that I had. It broke all-time highs. I mean, even back when we were making all-time highs in year 2000, of course, you know, the markets were different back in these years. But I remember in 98 when we were putting bottoms in on how this thing had the big monthly breakout here, and we thought that those were high readings back in those days. I was there. I remember it just like I remember what I'm doing right now here with you. Then we got the big capitulation breakout in 2008. When that peaked, the bottoms put in their all-time bottoms. And when this went down, stocks were breaking higher in the indexes and moving higher. And as it kept going down, stocks had a great over 2-year rally. Then all of a sudden, guess what happened? We got to a point where we called a market top twice this year. One of them was part of this spike. We haven't taken that monthly spike out. That meant, what does the wick mean, MMTs? Let me tell you what these monthly wicks mean. The minute that this monthly wick happened, MMTs, you were bouncing off the bottom in equities and the indexes. When this was coming down like that, that's a long wick down. Okay? When that was going that way, when that wick was like doing that way, whether it's a 3-minute, 15-minute, 60-minute, daily, weekly, monthly, yearly, it means one thing. We peaked, the fear was there, the markets were capitulated at the bottom at that time, and that came down and equities burned and made the 2011 52-week highs in the S&P 500 up at that 1370 handle and said, goodbye. Goodbye. So basically what I'm trying to get with my new people is that this is a lagging indicator and it doesn't work right away. And you got to know when markets are going to put bottoms in. It's a pretty big healthy move as far as this June monthly bar goes. It is not final, however, until the closing of June. Now, we've got Greece going to get, and it got down, the low of this reading was 15.95. Right here. It's right here. Low reading, 15.95, and the high is 24.65. And that's part of the 2 weeks of trading in the month of June. What the options quadruple expiration month quarterly in there with the monthly expiration. And so we've gone straight up and we have a little bit of a wick, but it doesn't suggest that we have put in a double top yet. Now, granted that the markets are short-term oversold. That's a forgiven. Okay? And we're not in bull overbought zones by any stretch of the imagination. We've had 7 good weeks of selling. Okay? The thing about it is it caught everybody off guard because they don't know, the big bull, big money doesn't know when to come out. No one comes out at the right time. You got to spot the overbought process and start selling into rallies. Well, if we continue to go higher on a weekly chart and a daily chart, this is the weekly chart compared to its monthly chart down here, over here. This is a monthly bar. This is a weekly bar. We've had 3 weeks of breaking out above the 10-week, 20-week, 40-week, and testing the 100-week moving average. This over here was the last peak of the highs that have yet to be challenged. Short-term markets are oversold. This can pull back and test these moving averages, set up a base, part of scenario, set up a base right about there, pull back to it, and if it doesn't break below it, there's still a certain amount of fear that's in the market. Now, remember, the fear event is a lagging event. And it has to deal with a market that opens up, goes down a couple hundred points, then they reverse immediately, and they go back up into positive territory. That's when you know that you capitulate to the high side here, and it comes down like it did. And I'm just going to draw a trend line right here at the bottom of that bar. That's where this current resistance level is. Any elevation above here in the S&P 500, even though that we're short-term oversold for a bounce. And you could get that out of the grease deal today. And happy Father's Day to everyone. So the thing about it is if we stay elevated and consolidate on a weekly level, there's still a lot of fear in the market, still a lot of pessimism, and stocks will continue to sell short all the time, no matter what. We did hit a peak, though, right here, and we started to come back down on this weekly wick, which suggests that the short-term bull and bear sentiment is that we're at buying levels based on the put-to-call ratios that also are on the CBOE called put-to-call ratio, which gauges market bottoms as well. And that the put-to-call ratio at the current readings are at levels that suggest that we get a near-term bounce to the upside, and or we wash out the last part of the fear of the market and then we bounce from the oversold condition. And the mechanics of it will be A, B, C, and D, and E, which will be given to MMTs during the live market hours. It won't be given to you on the video. We'll do this after the video. The video for you MMTs is reference as to what you're going to write down in your notebook journal. Because it's not my job to save the public. The public needs to learn to be accountable if they're going to be involved in the market, that is. And they're going to have... if they're not going to be accountable by getting educated correctly, then, you know, they deserve what the market gives them. And they can take what the market gives them. And without the proper education and the proper understanding of many, many, many different areas of the market, the public will just always do what it does. They'll make money at times. They won't sell. It'll come down. But then there becomes a point where the fear gets high enough. That's when the sellers are out of the market, MMTs. So when we can spike, and in the short term of a 6 to 7 week correction that we have, the mechanical, mathematical part, the mathematical readings that SMF have in the platform clearly suggest that we're due for a short-term bounce. However, let it be knowing that when this pulls back, that bounce will be into play. But when this stays elevated, meaning that it has to turn around, and let's lag in a few weeks of the move, because if you go back 1, 2, 3, 4, 5, 6, 7, this is where it started, where we said it was going to start right over here. And you can find these very same readings on stockmarketfunding.com under VIX. Just type it in. There's a search box there. There's all kinds of things. You'll find it. Then look at the videos and look at where we're really in the market, and then sit down and scratch your head a little bit and find out who has the best analysis But what is the analysis based on? It's always based on before any event ever occurs, before the fact. If you're going to base analysis after something's already happened, well, I don't call that very good analysis. And it certainly doesn't make me money. And it doesn't tell me what I should be doing with the marketplace. However, proactively, I do know that the mechanics of this is a laggard MMTs, but you can use this on your 3-minute and 15-minute and 60-minute charts on a daily level so that you can understand where that buyer and seller, does the buyer have a lot of bull in him, or does the seller, is the seller, the short seller, number one, and the people that are selling out of fear, number two, is what supports these breakouts higher. So you get more people selling out of fear. They never sell at the top, but they like to sell at the bottom. That's what they like to do. What about selling at the top and buying back at the bottom? Is that against the law? Is it against the law to learn how to take advantage of this and put money in your pocket and use the market the right way instead of the market using you? Because when the market uses people, that's when the fear breaks higher. There's very little control in emotion. There is none that I know of, because it's an emotional event without a plan. Emotional events do not have plans. Emotional events do not have stop market orders. Emotional events that people create within the buy and sell transaction within the Wall Street doesn't have emotion. It's just a fiasco. That's how you get these big sell-offs. You get these big fear indicators. When people are complacent, though, on the other hand, and the bull is very happy. He's out in the pasture, grazing on the grass, getting his water. No worry. Just a happy old bull. That's when you're down here at the bottoms, and that's when most of the big money's in the market. And during this time, we've had some people go to cash because they think there's a contraction in the economic growth cycle and worldwide cycles. Not to mention, we specialize in all of those events and the different kinds of tools that are used that we developed. We don't use other people's tools. We develop our own. These are public tools that the public is given. And then people will write about them in chat boards until they can't write no more. So what? That doesn't make you money either. I mean, at the end of the day. It's how to be in these events ahead of time. And what are the characteristic patterns of the behavior of A, B, C, D, and E with a well-written out plan and a well-written execution plan to trade and invest in markets? That's the bottom line. Let's be clear on what the bottom line is. It takes a plan in both bull and bear markets. If we come up here and hit the 200-week moving average, the green line, and we start to trace, we will have to use our 60-minute and our 3-minute charts on this fear indicator so that we know that when this is breaking down, we're net long equities making a fortune. And what will happen is, the only thing is that in the last 2-week period, a lot of short interest has come in the market. They always lag about a month to make decisions, about a month later, because everything is always after the fact. But what about before? That's what stockmarketfunding.com is good at doing. Go look on the homepage and look at all the events before the fact, and then you give us your report card if you're capable of it. But that's just if you're watching this thing because they go on YouTube, and that's where MMTs get their video files. Now, this thing here is if we consolidate up here, then that means that we haven't, that there's indecision, and people quite haven't made up their mind if they're going to be extremely fearful yet or if they're going to start getting bullish. But here's the thing, if you consolidate higher, there's less bulls. Now, the put to call ratio suggests that we're getting into a near-term area. It's going to take a catalyst of news headlines to get that bull swinging back, because the bull and bear sentiment has really changed. And the bull and bear sentiment always changes when this level is at high levels. You have less bears down here and all bulls in, and you have more bears up here and less than bulls. Let it be known, I'll be doing a lot of work between now and September, and we have a quarterly earnings coming up in July, right around the corner in a couple weeks. I'm very excited for that one. What markets do MMTs is that you've been taught all year how markets price in events, how earnings price in events, or broader equity indexes, and the actual price decline of an equity can price in a bad earnings report. There will be a lot of volatility, of manipulation volatility, that investors can never wade through, or traders for that matter. Why? Because it's all about that. There's no system to that. Our system will let us know the minute, the very second, when we start getting that change. Like I said, there are lots of events that are coming, and that bull has got to be convinced that year-end GDP is going to be above 2.4%. We had talked about 1.8% and 2.4% ourselves many months ago, before the year even started. Did that analysis in 2010. What it would be like in June of 2011. And we're 2 weeks into it. The key factor is, if this comes back down, then we will be bouncing in equities long off of the short-term oversold condition. That's what we will be doing tomorrow morning, which will be Monday. Today, 6/19/2011, 8:26 a.m. Pacific Standard Time. This clip for MMTs is to understand what the couple of next 10 trading days, daily trading days, are going to be like. And Monday starts with day trading 1 day to 5 days, closing Friday, and then the following week another set of 5 days. And mathematically, there's going to be an equation within those 10-day period, daily periods, that is going to tell us where the strength of the fear, or less than fear, and more bull and less bear start to set themselves up for either a deeper sell-off. But doesn't matter, because we have not truly put a bottom in. There's a difference between a real bottom and a short-term oversold market, MMTs. The reality between a true bottom and short-term oversold markets are huge. That's meaning that short-term oversold means we take equities higher, we sell into the rallies. Big money would be selling into the rallies as well, because we haven't put in a real bottom for 2011, whatever day that's going to come. And it will come. But if we pull back here and we hold this trend line here, that means that there's still a degree of fear, and the bull and the bear are mixed with each other. Remember, the bear can be scared because they're betting that the markets keep going down, but when markets change near term and go higher, the bear has to buy to cover. And there's short interest in the indexes that have increased in 2 weeks. Meaning the short interest increase didn't come until 5 weeks until after the reversal. Well, when you're selling short stocks at overbloated prices at the very highs of the year, you're making a great deal of money when this is happening, because this confirms that short. But notice that for 1 week, 2 weeks, 3, 4, 5, 6, 7, this is where we called the bottom, the top of the markets right here. Then you have the big spike like you always do, and you pull back and you test it over here. So 3 weeks there was indecision between the bull and the bear right here. They didn't know what to think, because they didn't. Even though that we peaked in the fear, it came right back down, but it never broke that support, and you've had a lagging 3-week breakout. So you need to know that there was 3 weeks they didn't know what the hell to do after they had this first big up move. Then, bam, That's where the selling increases and the fear escalated. And then we have the wick that comes down. And we have a short-term oversold market. Learn how to understand the S&P 500 index. Learn how to understand bull, bear sentiment. Learn how markets, short-term bounces or short-term oversold are going to react to this lagging fear indicator. And it is. And we have other, this is a public chart, and it's a public one. The SMF has its own in your platform. And that platform is going to be your guidance on when to be net long and when to be a net short seller, and when those mathematical equations change as to what side of the market I should be on. Happy Father's Day, everyone.